Amgen Stock, ticker symbol AMGN. This stock is down 6% on the year-to-date chart, while the overall market, in this case the S&P 500, is up 8.5%. So that's a big difference to start with. Amgen beat on revenue and EPS was in line. And for the upcoming earnings, almost all analysts expected Amgen will miss the earnings estimations. They will present their quarterly results on the 27th of April, which is very soon. From a dividend point of view, things look pretty interesting, with dividend yield at 3.46% and the 5-year growth rate at 10%. But does this mean that Amgen stock is a buy at current prices? Well, in this video I'm going to show you real quickly what Amgen does. The most recent earnings report, the fundamental analysis, dividends, returns versus the S&P 500, comparison versus some major competitors, and in the last part I'm giving you my price target to see if they are a buy or not. And I think you definitely want to see that part, so make sure to watch until the end. And I'm also very excited to see what you guys think about this stock, so please let me know your thoughts in the comments. My name is Thomas and this is Thomas Invest. I'm an investor looking for great stocks at great prices. So, what does Amgen do? Amgen is a leader biotechnology-based human therapeutics located in the United States. If we dive in the most recent results, we see a few highlights. For the fourth quarter, total revenues were 6.8 billion, largely unchanged from Q4 2021. Q4 revenues benefited from a 4% increase in product sales, offset by lower other revenue from the COVID-19 manufacturing collaboration. Product sales growth was driven by a 10% volume growth, partially offset by a 3% lower net selling price and 2% negative impact from foreign exchange. For the full year results, total revenues increased 1% to 26.3 billion, resulting from a 2% increase in product sales driven by a 9% increase in volume, partially offset by 5% lower net selling price and 2% negative impact from foreign exchange. So my take on this is that they are able to grow the business in volume, but as most companies they struggle with foreign exchange and prices. And that's also reflected in this point. EPS decreased 11% in the fourth quarter, and on the full year results EPS decreased 18%. Operating margin decreased 270 bps to 34%, which is still a good number of course. In this table we see that for the fourth quarter the results weren't that spectacular. So that's also one of the reasons why analysts expect another miss on the next earnings results. For the full year it still looks pretty decent. If we check the portfolio breakdown, we see that they have a wide range of different drugs. And we also see a lot of changes in total sales year over year. Some of them are increasing at a high rate, such as Avinity and Parsabiv, if that's how you pronounce it. But we also see some big decreases at Kanjinti and Neulasta. If we check the biggest drugs in terms of sales, we see that Prolio is increasing 12%, which is pretty decent. Otezla is reporting nearly flat numbers. Enbrel is decreasing, Nplate is increasing 27%, which is very nice, and Neulasta is decreasing 35%. So we see a mixed results for the top drugs, which is something that I don't like. Another interesting thing is the cash flow statement and the debt number. First of all, free cash flow is decreasing a bit year over year, which is something that I don't like. Amgen also didn't buy back any shares in the fourth quarter, which is also a bit disappointing to me. Right now, debt is at almost 39 billion, while last year it was sitting at 33 billion. So debt is increasing big time, which is not necessarily a bad thing, but with free cash flow decreasing, I don't like to see the debt increasing. For the 2023 outlook, they expect to have revenues in the range of 26 to 27.2 billion. In 2022, they reported 26.3 billion in revenue, so that's a small increase. GAAP EPS is expected to be in a range of 13.16 to 14.41. Which is a decent increase compared to 2022, so that's something that I really like. Share repurchases is expected not to exceed 500 million, which is again a bit disappointing to me. And now that we know more about the company, it's time to check the fundamentals of this stock. But first, if you made it this far into the video, I want to thank you lots for watching this video. Make sure to subscribe to my channel to receive multiple analysis every week. And also join my Discord channel for free to meet other people within the community and to talk about stocks. It's completely free, so don't miss it out. Let's continue by diving into the fundamentals. Amgen is a 135 billion market cap company. PE ratio is at 20, which could indicate that they are fairly valued right now. Later in this video I will show you my 3 price targets for Amgen, so make sure to watch until the end, because PE ratio is only telling a small part of the full story here. Revenue is at 26.3 billion, and in this graph we see that revenue went up quite nice and steady over a longer period of time. In the most recent quarters, Amgen is facing a slowdown in revenue, which is of course something to keep your eye on. Margins are going up and down over a longer period of time. In the most recent quarter the margins decreased as well, so again something to keep your eye on. EPS is going up most recently and it's expected to increase in the coming quarters as well. However, the historical pattern isn't really steady and consistent. Price to sales ratio is at 5 right now. Over a longer period of time it's increasing. The current number does not look good to me, and given the fact that it's increasing is also something that worries me a bit. Price to book ratio is pretty much the same story. And price to free cash flow does look good to me. It's around the 15 mark and it has been there for a longer period of time, indicating that it's undervalued. Analysis expect EPS to increase at low to mid single digits, which looks decent to me. It's a slow growing company. That's also reflected in the revenue expectations. Analysis expect to see a low to mid single digit revenue growth in the coming years. Return on assets is sitting at 14.9%, which is above my 10% minimum. So this looks very good. Return on equity also looks really good. And the most important number, return on invested capital, is sitting at 21.8%, which is a really good number. Another thing that I really like is the fact that it's above the 5-year average of 21.6%, so they are doing a great job here. Current ratio is at 1.41, which looks pretty good to me. I prefer a number below 1.5 here. Total debt is sitting at 39.6 billion, and I prefer companies that can pay down at least a third of the total debt with the total cash position. Right now total cash is sitting at almost 9.3 billion. So they can't pay down a big chunk of their total debt, which is something that I don't like. But it has to be said that they are not far away from having a good ratio here. Nevertheless, it's very important that free cash flow is growing, since this is used to pay down debt of course, but also to buy back shares, pay dividends and all other things. And in here we see that free cash flow was going up in the long run. However, in the past couple of years it decreased a bit, so keep an eye on this number as well. Another thing that I love about this company are the shares outstanding. It's going down in the long run. It means when shares outstanding are decreasing, it increases your ownership in the company, increases the EPS, lowers the PE ratio and makes it easier to maintain and increase the dividends. And since we are talking about dividends anyways, dividend yield is sitting at 3.46%, which is a decent number. Annual payout is at $8.52 and payout ratio is at 43%. I prefer 15% or lower. So right now they have roughly 57% left in cash to buy back shares, pay down debt, acquisitions, research and all other things. The 5-year growth rate is at almost 11%, which is really good. On top of that, they grew the dividends for 11 years in a row, which is also pretty impressive. Overall, a great looking dividend scorecard, but how about the historical returns? I decided to compare Amgen stock with the overall market, in this case the S&P 500. Next to that I added Gilead Science and REGN. On the 5-year chart we see that Amgen underperformed the S&P 500 by a small margin. Amgen returned 63% while the S&P 500 returned 67%, of course both including dividends. Gilead had a 34% return, which is not that great, and REGM had the highest return with 151%. On the 1-year chart it looks pretty different. Amgen returned flat numbers while the S&P 500 is sitting at minus 3.75%. Gilead returned almost 42%, which is the highest in this list. On the 6-month chart it's again Gilead having the highest returns and Amgen returning flat numbers, which is very interesting. On the 1 month chart, it's the S&P 500 that has the lowest return, while the other stocks in this list had similar returns. So bottom line, Amgen underperformed the S&P 500 in the long run, but also the competitor. How about some fundamentals compared to other companies in this list? We see that these three companies are quite different in market cap, enterprise value and employees. Amgen has a PE ratio at 20, while Gilead is sitting at 23. AMGN is sitting at 21. And to be honest, it's not far away from each other. Price to sales is looking quite similar, being too high with all companies. Price to free cash flow is the lowest at Gilead, but both Amgen and AMGN have decent numbers as well. Revenue growth year over year is not looking good for all companies. And so is the 5-year compound annual growth rate, except for AMGN, which is sitting at 15%. With the net income compound annual growth rate, AMGN is also the winner. And last but not least is the free cash flow compound annual growth rate. AMGN is again the winner here. Gilead had the highest gross profit margin, but AMGN has the highest net income margin, which is very interesting. Free cash flow margin is the highest at Amgen, and so is the return on total capital, which is very nice. Both Gilead and Amgen have quite some debt compared to the cash position. AMGN has enough cash to pay down all their debt, so they are the big winner here. The last thing that I want to check are the dividends. AMGN doesn't pay any dividends, so I will be comparing Amgen and Gilead. And to be honest, they are quite similar. Dividend yield is pretty similar, being 3.46% for Amgen and 3.58% for Gilead. The dividend growth rate is the highest at Amgen, and they also have the most consecutive years of dividend increases. Overall, I think all companies in this list are quite similar in terms of fundamentals. Not all fundamentals are exactly the same, of course, but there is no big winner here, beating on most fundamentals. So is Amgen stock a buy at current numbers? Well, let's check the 3 price targets that are created using the Everything Money software, which is one of the best tools out there. I'm using a low, mid and high assumption to get the 3 price targets, starting off with the revenue growth. For the revenue growth I'm filling in 1, 2 and 3%, since I think they will increase their revenue at the same numbers versus the historical averages. Next to that, it's also based on the analysis expectations and the current outlook. Profit margin I'm filling in 24, 25 and 26%. For the free cash flow margin I'm filling in 33, 34 and 35%. For the PE ratio and the price to free cash flow I'm filling in 18, 19 and 20. My desired annual return is 12.5%, since I can get an easy 10% average annual return with owning an ETF. Right now Amgen stock is at $246. I hit analyze and we only see one green number. We have a low price target of $139 to $192, which is a big drop from the current stock price. We have a mid price target of $161 to $219, and we have a high price target of $186 to $250. To me, the high price target is the most justified here, since I expect the company will increase their margin and free cash flow margin is also going up in the coming years, I think. Revenue growth will be around low single digits. Based on this price target, we have a range of $186 to $250, showing that it's within the current price range, leaning a lot to the higher side. My final conclusion on this stock is that I do like the business. It's a well-known company with some top drugs in their portfolio. However, they are facing some difficulties with the revenue growth and currency impact. The next earnings results on the 27th of April will have a big impact on the stock price, but also on the future of this stock. The current outlook for 2023 isn't that spectacular, and if they disappoint in the first quarter already, they might have a big problem. From a dividend point of view, things look pretty interesting. They pay a solid dividend, have a pretty good growth number and also a proven track record, so nothing wrong with that. However, from a value point of investing, I don't think it's a buy right now. I think the stock price should go down big time and the results should improve. Until then, I'm skipping this stock, since I think there are better deals out there. And remember to always do your own research and never fully trust on what I or other YouTubers say about the stock. I'm not a financial advisor and this content is just for entertaining purposes only. I hope you liked this video and I did bring some insights of the company to you. I would really appreciate a thumbs up and make sure to subscribe to get notified when I'm posting a new video. Thanks for watching and I will see you in my next video.